So you assume that when you enter a trade, you either win or you lose. And if you're risking 1%, you lose 1%. And if you're risking 1% and you win, you make 3%, 4%, 5%, or even 10%, depending on your risk to reward. But what I'm here to actually tell you today is there are some hidden costs that people do not take into consideration when calculating how profitable their strategy is over the long term. So I'm going to break that down for you today. I'm going to give you some examples on the charts, and we're going to do a little bit of maths to show you how this can be eating up your profits and causing you to be a losing trader. You'll often see traders who are break even, but they still end up losing money long term. And in this video, it might make sense as to why that is actually the case. So we're going to start by talking about spread. People see spread as, these two little lines, this bid and ask line, and they don't really think much of it. But what I'm here to tell you today is that it can eat up a lot of your profit. I'm going to give you an example here. Let's say right now, or here I was buying GBP USD. So let's just put the right risk reward tool on here. Let's say I was buying GBP USD here with a 1 to 3 risk reward. Okay, so you'd assume if I get in at this point, that's my stop loss, that's my take profit, that's it. But what you have to actually account for when you are using a limit, when you are using market execution, the price can change. The bid and ask can change, the spread can widen at any time, and sometimes you'll have it where you want to enter at this price here, but it actually enters you up here. So now your entry is up here. So what this basically means is if we look at this in terms of pips, so that's 1.1 pip. So let's just say 1 pip higher than what you actually wanted to get into the trade. And if you have been trading for many months or many years, you will have had this happen to you, and you probably won't think much of it. The reason this is bad is because your stop loss is now in the same place. So your stop loss is here for a reason. You're not going to suddenly reduce your stop loss size just because you got a worse entry on your trade. So what you're going to do is you're going to leave your stop loss in the same place, but you're going to obviously move your entry up because this is where you actually got into the trade. So now your stop loss is 11 pips, but you have calculated your risk for 10 pips. So you're already risking 0.1% more from the entry that wasn't perfect. So this is why I always say to people, you need to account for spread. When I'm calculating my risk, when I see others calculating the risk, I always say account for spread. Because if you're losing 0.1% every single time you enter a trade, if the conditions that you're trading are bad, especially on prop firms, those conditions are usually not the best, is probably the easiest way to put it. It doesn't seem like a lot, 0.1%. If this trade wins and I make 3%, it doesn't really matter. But again, you are technically losing that 1 pip to the upside as well. So losing that 0.1% to the upside that you also would have lost to the downside, which you need to consider. So it doesn't seem like a lot on one trade, but let's say you take 100 trades in a year, that 0.1% does add up to quite a lot. And if you obviously times 0.1 by 100, you get to 10. So over the year, you've lost 10% just from this spread and market execution issue, or perhaps the broker using doesn't execute your limits perfectly. You are going to have this issue, and it can grow. As I said, 10% per year for 100 trades. That is quite a lot of profit that you're missing out on. And again, it might not seem like a lot to you, but let me put this into perspective. Trading a $100,000 account, whether this be a prop firm or a personal account, 10% is $10,000. That is quite a lot of money that you're leaving on the table just by not calculating your risk properly and accounting for spread. This is also why you see a lot of traders switch over to futures. The spread issues are not as large on trading futures, especially with futures prop firms. People love moving over there. You're in profit instantly and you can make tons of money, and you don't have the massive issues of spread and slippage like you usually have on CFD accounts. And that is the next point, slippage. People don't see slippage as a lot, but again, I'm here to tell you that it does add up. There's probably going to be a recurring theme in this video of small losses adding up, but it is one that you definitely need to take into consideration. And the 3 points I'm actually going to talk about, if you combine them all together, what you could potentially be losing in a year can be quite large. So let's say you are in this trade here, and then price does this. Boom, melts to your stop loss. And let's say you have one of these candles push up, or you have one of these candles, or one of these random wicks, and it goes through your stop loss, you can get slippage. People only really see slippage as a bad thing if it is, increasing their loss by a large amount. So a 1% loss turned into a 2% loss, people see that as bad slippage. I personally see any slippage as bad, because if I'm risking $1,000, I want to lose $1,000. I don't want to lose 1,150. Because again, let's say we have this scenario here where we've already lost that 0.1% because of the entry being slightly higher because of the spread. We're now losing an extra 0.15% from the slippage. So quite quickly on one trade, we've lost an extra 0.25% because of the spread and the slippage. I'm not saying this is going to be this extreme on everyone's broker and on every single loss, but it's definitely something you need to take into consideration when calculating your overall stats. Most notably in backtesting. Majority of people, when they are backtesting, they just look at, okay, I won 30 trades, 1 to 3. I made 90%. I had 20 losses. Okay, I'm up 70%. They'll see that, okay, perfect, up 70%. But they need to account for the spread, the slippage, and the commission. If you're not accounting for these 3 different things on your results, then you do not know your results. You need to know what's your average lot size going to be. And based on that average lot size, what's your commission going to be? How much are you going to lose on spreading slippage on average, on an average loss? Are you going to hold through news? What is the potential slippage on that? The spread during news obviously is heightened. Are you going to hold overnight? Okay, now you have swap charges. So all these different things that you need to take into consideration when figuring out if your strategy is profitable or not, and what results you can actually expect in the live markets, is key to actually having a profitable strategy. You often see people talking about their results net of fees. And what this basically means, for those that are unaware, your results, let's say you make 70% in a year from your backtesting, you take away your spread, you take away the money you're going to lose on commission and potential slippages, and that is what you're actually going to make. This then gives you a realistic result that you can aim for. If you are doing your backtesting, you return that 70%, you haven't accounted for any fees, you take the exact same trades in the live markets, let's say you technically make that 70%, but you're only seeing 60%, you're probably like, why am I only making 60% when I've won the same amount of trades, I've got the same win rate, the same average risk to reward, why am I not making the same amount of money? Well, I'm here to tell you that it does add up with those fees. I'm going to show you a quick example on my phone here. If I go on this week of trades, you see we have made around $7,700, but what you don't see is, let's say this trade, for example, $67 in charges. So that means just for actually opening this trade, I've been charged $67. Over 100 trades, that is a lot of money. If I do that for 10 trades, I'm being charged $600. Over 100 trades, I'm being charged $6,600. And as this is a 100K account, I know that every 100 trades I take, I'm losing 6% from the commission just to actually enter the trade. And that is where it is very key to understand how much you're actually going to lose. And that is the last point on this video. You'll see certain brokers, certain prop firms, they promote the fact that they have low commission. And this is something you definitely need to pay attention to. Most people see it as, oh, if I'm making $1,000 on a win, who cares about that $30 commission compared to $60? But over 100 trades, 30 compared to 60, you're saving yourself $3,000. You're saving yourself 3% on a 100K account. And that is something you need to take into consideration alongside all the other things I've mentioned in this video. And if you are only focusing on one of these and not any of the others, again, you're just missing out on hidden costs. I'm not saying you have to completely change your strategy to account for these, but it's something to be aware of. And when you are comparing results before fees and then after fees, you have to work out, okay, perhaps I wasn't accounting for these before I was getting into my trades. And this is something I didn't realize back in the day, trading my strategy. I thought, okay, if I make 70% in backtesting, I take the same trades live, I make 70%. But then I realized that was not the case, because you'll notice it if you are break even. If you'll notice, you put your strategy into my effects book, it will say how much you actually have in commission total. If you look on MT5, I'm pretty sure it will show you how much you have in commission. So you could be net zero or break even on your account, but still be down $1,000 because of commission and because of swaps and all these other factors that are actually accounting for extra losses in your trading. If you have any other hidden fees that you think traders should be aware of, be sure to comment them down below, and I'll catch you guys in the next video.